and welcome to episode 20 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event driven activity over the past week. My name is Asif Surya.
My name is Tamanna Surya, and I currently attend the University of California, Los Angeles. And if you're noticing a switch in location, perhaps even a swap, that's because I'm home in the Bay Area for the weekend.
After having a second guest on the podcast last week, we get back to regular programming this week. On this podcast, we will discuss the US Steel and Nippon Steel deal getting closer to the finish line, a higher offer received during a go shop period for Satisfy Communications, potential deal for TXNM Energy that was rumored and came to fruition, a massive stock buyback announced by the company that makes the popular Hoka and Uggs shoes, and a whole lot more.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
And if you've been enjoying this podcast, do us a huge favor and take a moment to like, subscribe, or rate this podcast on whatever platform you might be listening on. So let's get this podcast started with M&A activity, and specifically a current deal, which was the biggest story in M&A last week. And it was because of a post from President Trump that indicated that US Steel and Nippon Steel are likely to go through with their deal. The spread immediately collapsed from over 28% profit to just 5.75%. Just days before that post by President Trump, the famous hedge fund manager Dan Loeb of Third Point had tweeted that you can actually drive a Cybertruck through the Nippon US Steel spread.
The revised 5.75% spread is still quite attractive for ARBs if the deal closes in the next month or so. The reason it exists is because of the on-again, off-again policies by the Trump administration and worries that the deal could still get derailed. The canary in the coal mine that the deal was likely to go through was a second CFIUS review, which was highly unusual.
Yeah, we discussed this in one of our podcasts in early April after President Trump directed the Committee on Foreign Investment in the United States, or as it is more commonly known as CFIUS, to conduct a review of the proposed acquisition of US Steel by Nippon Steel. CFIUS is the government organization that reviews cross-border deals for national security concerns.
The stock was up 16% in a single day following the announcement, and the spread collapsed by quite a bit because the market took this news to mean that the deal might close. Most merger arb-focused funds with a concentrated portfolio that we follow had a long position in US Steel, and many of them had hedged their position using put options.
Yeah, I noticed that some of them had this position when I did a Q1 review of their portfolios. And I was almost thinking about starting a position in US Steel using put options as protection, but I guess it is too late for that now. We mostly hear about deals falling apart, and depending on the premium paid and the prevailing winds in the industry that the company is operating in, a deal break can easily cause a big drop in the stock price of the target company. This is the key risk in merger arbitrage, or as it is aptly known as risk arbitrage, and was one of the reasons I had stayed away from the US Steel deal.
What we rarely hear about is deal prices being revised upwards because of rival bids. Last week, we saw a rare go-shop period bump in price after the satellite communications company Satisfy Communications received a third-party offer, and MTA Space Holdings bumped up its offer from $2.10 per share to $3 per share, which implies an aggregate equity value of about $280 million. Some merger agreements have a short go-shop period, often 30 days, where the target company can solicit additional offers. Most of these go-shop periods expire without an offer, but this one was an exception.
Yeah, this bump in price for Satisfy reminds me of the amended merger agreement for Bluebird Bio recently, where Carlyle and SK Capital Partners bumped up the price from $3 per share in cash and a CVR that could be worth as much as $6.84 per share to a new deal price of $5 per share in cash. Investors have the option to choose between the old offer that includes the CVR or the new all cash offer for $5 per share. I was curious to see how many deals this year saw a higher offer. And if we don't consider pre deal situations like the fashion and apparel company Guess, there was the Acelerin and Alumis deal that closed last week, where the price was revised upwards with the same acquirer. Then there was the tiny Wakasa Kasago deal, and also Herc Holdings coming in with a higher offer for H&E Equipment Services, which made United Rentals walk away from that deal. The deals that we thought would receive a higher offer but closed on original terms or very close to the original price were Silver Lake's acquisition of Endeavor and QXO's acquisition of Beacon Roofing Supply. Overall, I think it is very encouraging to see these higher prices for certain deals, and it adds a tiny bit of excitement to what is generally a low key investing strategy.
Exactly. For another Deals in the Works update, the CEO of the edtech company Chegg announced in an earnings release that they are in talks with rivals and PE companies for strategic alternatives to maximize shareholder value, including being acquired or undertaking a go private transaction. Chegg now trades at just 98 cents per share, having lost 73% of its value in the past year and 98% of its value in the last 5 years. I'm amazed that the company once traded at highs of over $100 per share. But to be fair, this is a general trend that we're seeing in the edtech sector. Nerdy, Udemy, and Coursera have all also faced massive losses in the last few years. I remember Coursera was one of those companies we disagreed on when it came to investing, right?
And you turned out to be right about it. Clearly, the impact of AI on edtech has not been very positive, and these companies are struggling to survive in an area where AI can actually replace them for certain purposes. Switching gears to a different deal, back in March, we discussed a potential deal for TXNM Energy, a utility that provides electricity in Texas and New Mexico and was previously known as PNM Resources. The company indicated that it is exploring a sale after receiving takeover interest from a potential suitor. And according to Bloomberg, that potential suitor might be KKR.
The latest update from last week is that Blackstone was the one to actually strike a deal with TXNM Energy for $61.25 per share in cash. As we mentioned before, PNM Resources may be recognized by some merger arb investors because Avangrid announced an $8 billion acquisition of PNM Resources in October 2020, but that deal failed in January 2024 due to the New Mexico Public Regulation Commission voting to reject the deal.
This is one of the pitfalls of getting involved in deals related to insurance companies, utilities, and banks. There are multiple regulators involved, and they often drag their feet. Although this time with the PE firm or potentially acquiring TXNM Energy, regulatory approval will hopefully not drag out for as long as it did with Avangrid, which, if I remember correctly, took almost 3 years before the deal failed.
It is also worth noting that earlier this month, TNXM Energy announced that it is going to promote its COO to the CEO role starting on July 1st of this year. The prior CEO, Patricia Cullivan, was in the role of CEO for over 15 years. We had a couple other smaller deals announced over the past 2 weeks as well, where the spread was quite tiny, but we figured that they would be important to bring up nonetheless. Marfrig Global Foods is acquiring BRF in an all-stock deal valued at $8.11 billion. BRF is a Brazilian poultry and pork company being acquired by the Brazilian beef company that already had a 50% stake in BRF. The spread on the deal is actually a negative 5% at this point, but given how much of BRF Marfrig already owns, I'm not quite sure that the deal price is going to get bumped up by any means.
Yeah, that 5% spread, the negative 5% spread, is actually quite surprising. The last deal we wanted to briefly cover was the acquisition of the athletic footwear and apparel retailer Foot Locker by the sporting goods retail giant Dick's Sporting Good for a closing value of $2.5 billion. Under the terms of the agreement, Foot Locker shareholders will receive either $24 per share in cash, or they can choose to get 0.1168 shares of Dick's common stock for each share of Foot Locker they own. The deal is expected to close in the second half of 2025 and quite frankly makes sense given the similarities between the two companies, but I feel that they might run into a little bit of regulatory trouble considering both of these are well-known retail companies, and it's entirely possible Senator Elizabeth Warren might speak up and say that either the DOJ or the FTC might need to look into this deal.
When it comes to our spin-off section for this week, instead of discussing new spin-offs, we wanted to provide a few updates to spin-offs we've discussed on this podcast in the past. A few episodes ago, we had mentioned that Sony was considering spinning off its semiconductor business, as that was what news sources were reporting at the time. 2 weeks ago, Sony announced that it was actually going to spin off its financial services business, Sony Financial Group, by distributing just 80% of SFGI shares to shareholders in a 1-to-1 ratio. The spin-off is subject to SFGI's listing on the Tokyo Stock Exchange Prime Market, with applications submitted in May 2025 and expected completion of the spin-off in October 2025, following board approval in early September.
There was another small update when it comes to spin-offs. In previous episodes, we had discussed the possibility of ABB spinning off its robotics division, the second largest robotics manufacturer in the world, with 2.3 billion in revenue in 2024, representing 7% of ABB Group's total revenue. However, the company recently announced that they were considering a sale of the division instead of a pure play spin-off, which was disappointing to some extent since we were actually considering buying into the spin-off as the robotics division in this age of AI looked quite attractive to us.
Moving past spin-offs into buybacks, Deckers, the company that was riding the popularity wave of Hoka shoes and Uggs, took a 20% haircut last Friday after reporting weak results with revenue growing just 6.5% to a little over $1 billion in fiscal Q4. All of this growth came from international markets. What really weighed on the stock was their forecast for fiscal Q1 sales and earnings, which came in well below estimates.
Given this on again, off again tariff situation, we knew that the forecasts from anything to do with retail were going to be conservative or downright dismal. And I've seen a lot of Hoka shoes lately, but had not paid much attention to Uggs. I pulled up the website and was surprised by how expensive they are. A simple clog was priced at $140.
Well, people are buying those $140 shoes. I personally still see Uggs everywhere, even more than Hoka, actually. But going back to the company itself, Deckers was already buying back stock, and following these results, they upped their buyback game by approving an increase of $2.25 billion to the company's stock repurchase authorization, which brings the total outstanding authorization to approximately $2.5 billion. This $2.25 billion increase represented nearly 12% of the company's market cap at announcement.
As you and I know very well, some companies announce buybacks and then don't actually follow through on them. This is one of those companies that actually follows through on their buyback announcements, and they've repurchased more than 10% of their stock over the last 4 years. The stock has lost a third of its value over the last year, and unless margins get killed, which is entirely possible, it is starting to look cheap at 15 times EV by EBITDA.
Another buyback we wanted to quickly cover was at the luxury hotel REIT Xenia, which stood out to us because we've discussed hotel REITs like Playa and Pebblebrook on this podcast before. Xenia currently pays a modest dividend of around 4% and trades at a price per FFO of 6.93. The company announced a $100 million buyback, representing 8.22% of the company's market cap at announcement. Xenia has been pretty committed to following through on their buyback programs. They've bought back more than 11% of shares outstanding over the last 3 years.
Last but not least, we wanted to cover the $4 billion buyback at the cystic fibrosis company Vertex Pharmaceuticals. This buyback is technically an additional authorization to a $3 billion buyback program from February 2023, under which $775 million had remained. The additional buyback represented nearly 4% of Vertex market cap at announcement. I've had a position in Vertex for several years at this point, after having discovered the company following two insider transactions by the CEO and a director that we like to call Two Briefcase Bruce. I have a case study in my book, The Event Driven Edge in Investing, about Vertex Pharmaceuticals, and I explain why I followed Two Briefcase Bruce into the company.
Speaking of insider purchases, let's move on to our insider section. We saw a cluster of insiders purchase shares at the healthcare insurance giant United Health Group, which made waves in December of last year, following the shooting of Brian Thompson, who was the CEO of United Healthcare, the largest division and the insurance wing of United Health Group. We covered the parent company in our latest C-Suite Transitions article that we publish once a month. Due to the announcement that the company's CEO, Andrew Whitty, would be stepping down from his role after a little over 4 years in the position. So the timing of these purchases are certainly fascinating.
Another really interesting insider purchase we saw was at Middleby, which is a worldwide manufacturer of solutions for commercial kitchens, residential appliances, including the popular Viking brand, and systems for industrial processing, packaging, and baking. We saw two different directors of Middleby purchase shares, including director Edward Garden, who had purchased a whopping $73.22 million worth of the company's stock via an SPV, or a special purpose vehicle, associated with Garden Investment Management.
We always like to see insider purchases from directors with an investing background, a bill that Mr. Garden fits perfectly. Mr. Garden has been the founding partner of Garden Investments since 2023, but from 2005 to 2023, he served as the Chief Investment Officer and a founding partner of Triand Fund Management. Mr. Garden did just join Middleby's board in February 2025, and we normally pay a little less attention to insiders that buy shares right after joining the company. But the reason behind Mr. Garden joining the board was unique. In our last podcast episode, during our interview with Rich Howe, we talked about special situations bonanzas, when there's a slew of special situations activity going on at a company. After looking a little closer at these insider purchases at Middleby, I realized that the company was another one of these special situations bonanzas. In early 2025, Middleby announced plans to spin off its food processing business, with the target separation date of early 2026. Mr. Garden's appointment to the board is to some extent connected to this spin-off and move, especially considering that Mr. Garden has been a director at GE since 2017, a company that we've talked about numerous times and written about numerous times, both before and after its incredibly successful spin-offs. To add to it all, Middleby also announced a $7.5 million share increase and acceleration to its existing buyback program. The total authorized shares available to be repurchased now represents 11.4 million shares, or 21% of the company's outstanding equity. The company's free cash flow is strong and has impressive margins for a business of its kind, isn't too expensive, and debt seems to be reducing year over year. The only thing that gives us pause when it comes to Middleby is the flattening revenue growth.
Certainly sounds like a very interesting company considering the investor that is involved and the fact that he was a co-founder of Trian Capital Management. Switching gears to activists, Bill Ackman's Pershing Square Capital Management built a new stake in Amazon.com, calling it a fantastic franchise and noting that they had acquired shares at an extremely attractive price. Bill Ackman isn't necessarily going to go activist on Amazon.com. There is nothing to necessarily try to move things, if you will, with either the board or the management. And it's just worth mentioning considering he does take on an activist role at certain companies.
A few episodes ago, we talked about the acquisition of Akoya Biosciences by Quanterix, which was so unique in the sense that we saw the deal price get revised downwards instead of upwards. The reason for the cut to the deal price was due to activist involvement in the parent company Quanterix, where Kent Lake Partners and Tikva Management both got involved to argue that the Akoya deal was not in the best interest of Quanterix shareholders, as it completely overvalued Akoya. Eventually, the activists won out and the deal price was revised downwards, and it seemed as if everyone was happy. That is, until earlier last week, when Akoya announced that it had received an unsolicited acquisition proposal from a third party to acquire Akoya in an all-cash deal, which was considered to be a superior offer to the all-stock deal that Quanterix offered. Kent Lake then got involved again to say that Quanterix should now drop the deal altogether, let Akoya accept the superior offer, and consider strategic alternatives, including a potential sale of Quanterix itself. So really interesting activist involvement in the middle of an active merger.
That is a highly unusual situation where the deal price got revised downwards and then they received a superior offer. I don't think I've ever seen anything like that before. And it seems like quite a few firsts, if you will. A rare offer during a go shop period, this situation, and so much more that seems to be very unique, including that second CFIUS review for the US Steel deal. Anyway, switching gears now to C suite transitions. While working on a monthly C suite transitions article, I was shocked to see that 80 executives at the C suite level departed suddenly, including 16 CEOs and 33 CFOs. We classify sudden departures as executive exits announced with short notice, where the executive is expected to leave within 30 days. So, one interesting example of a C-suite transition we came across recently was the land development and home building company United Homes, which just appointed their current president as CEO to fill in a role that's been vacant since October of last year. The company has had an interim CEO until now and who has stepped down and will remain on the board of directors. Earlier this month, United Homes announced that its board had formed a special committee composed entirely of independent directors to conduct a strategic review aimed at maximizing shareholder value, which probably means they're going to put themselves up for sale. The review will also consider other options, including asset sales and refinancing of existing debt. The company went public through a SPAC, and as we often see with SPACs, it's down quite significantly, almost 78% since going public, and it's down 61% just in the last year.
Moving on to yet another C-suite transition, two of our favorite biotech companies to talk about are Avadel and Ardelyx, a narcolepsy pharmaceutical company and a gastrointestinal and cardiorenal therapeutics company, respectively. We've discussed both companies separately on this podcast and written about them in our monthly newsletters on Inside Arbitrage. But it's quite interesting to see the two companies come together when we saw that Avadel had a new COO, Susan Rodriguez, who came over from Ardelyx, where she had previously served as the company's chief commercial officer.
Avadel had lost their chief commercial officer in December of last year, so we were waiting to see how that role might be filled. And it looks like Ms. Rodriguez is more or less taking over the responsibilities of the role, just under a different title. For other news related to Ardelyx specifically, we have seen Chairman David Mott make a few purchases over the last month. Mr. Mott once again is a director with investing background, having been a general partner of New Enterprise Associates, where he led the healthcare investing practice for years. He also has deep industry experience, considering that he's on the board of numerous other biotech companies. I guess it's just a really strange time for biotech companies. It feels like they are in a nuclear winter, and it doesn't matter if their drugs are getting approved or having successful readouts. Almost the entire sector seems to be pretty shell shocked.
Exactly. And with that, we'll wrap up episode 20 of the Special Situations Report. As always, what we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview, of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.